Hello, everyone, and welcome to Currency Exchange, a NatWest podcast series all about foreign exchange markets. I'm Brian Daingerfield. I'll be your host today, and I'm joined by Paul Robson, who covers G10 FX strategy for us in London, to discuss all things US and UK this week. It feels like fiscal policy expectations on both sides of the Atlantic are really driving markets right now, with some moves in the betting markets here in the US in favor of Trump, really helping maybe support the dollar recently. And also, we have the UK budget next week, and certainly causing a lot of interest in UK markets, both in rates and in foreign exchange. So, Paul, thanks very much for joining.
Well, thanks very much as usual for the invite. As you quite rightly said, some of those sort of risk events that have been on the horizon for it seems like months are suddenly upon us, and it'll be interesting to see how currencies react, and rates markets and risk markets. So I'm very much looking forward to today's podcast.
Yeah, let's start with the UK budget, because it feels like we've been waiting for this budget for a long time now. And it really is, I think it's right to say, maybe the big focus in UK markets at the moment. How are you thinking about the budget and fiscal policy as relates to sterling?
Yeah, it's certainly interesting because normally fiscal policy doesn't really move the needle on the currency. I mean, certainly when my colleagues in economics come and ask me for this little paragraph on the currency for how it might move for fiscal events, normally I say I don't really have much to say. But the trouble is, at the moment, the Liz Trust budget that caused volatility in markets, in bond markets, in the currency, I think still lives long in the memory. And of course, we've had a change of government, the first change in government to 10 years. And so there will be more uncertainty than there has been for a little while. The environment for sterling and fiscal policy is significantly different from back under Liz Trust. For example, remember, it was still the European energy crisis. The government was still having to subsidise household energy prices. There was also a particular factor around pension funds and how they were reacting to the budget. And so we don't really have those to think about now. But we are getting to a point where we could have quite significant increases in borrowing, and more borrowing than expected. And at the end of the day, the budget, bond markets, just like 101 economics, it's just supply and demand. If the government is supplying more bonds to the market and there isn't that demand, and of course there's lots and lots of governments around the world supplying lots and lots of bonds, it matters quite significantly. And it's getting that balance right for the currency. It matters. And in all these events, there's always a red line that doing too much, and I think that's the key message from the budget, it will be just more borrowing, more taxation, more spending. But if you get it slightly wrong, then it can impact the currency, because the currency is just a nice and easy way to protect people's portfolios. You can just sell the currency, or if you're optimistic, you can just buy the currency. It's much more difficult to change a portfolio of credit and equities and government securities. And so sometimes the release valve of tensions is actually the currency, and we've seen that in the recent past. I think for the currency we are in a bit of a sweet spot, because I think it plays to that idea of a cautious Bank of England in this global easing cycle, as all central banks are cutting interest rates, and maybe we'll come on to that in a little bit more detail. But I think ultimately the main focus for the budget, as I say, will be more borrowing, more taxation, more revenues, but it's the changes in the fiscal rules. The chief economist here at NatWest, Ross Walker, he talks about widening the goal posts rather than moving the goalposts, and sometimes that unsettles markets. So we'll be watching that very carefully for the currency. But as I say, a bit of a sweet spot, I think, for now.
Yeah, you hinted on where I want to go with my next question, which is that fiscal monetary policy mix, because it feels like for a lot of this year, monetary policy, and you alluded to this at the top, that fiscal policy has really been, I think, secondary for currency markets, not just for sterling, but for a lot of the currencies that we cover in the G10. where monetary policy has really been a very critical driver, and how fiscal policy feeds into monetary policy has been a big source of how fiscal policy feeds into currency markets. So I do want to ask you about monetary policy. How does this budget and the potential changes in borrowing feed into monetary policy, and how is that impacting your thinking about sterling here?
Yeah, I think you're exactly right in terms of that interconnection between fiscal policy and monetary policy, because they are interlinked. Sometimes they're the opposite side of a coin. And as I mentioned, it feels like we are getting into a bit of a sweet spot where it keeps the Bank of England cautious, cutting rates when there's other more enthusiastic easers of monetary policy across the G10. And I think that's actually going to be an important theme for the year ahead. That interest rate difference between, say, the Bank of England and other central banks, what we would call as a carry position, it looks like it's going to be supportive of the currency over the next 12 months. If I look at that balance, it's going to be the most in favour of sterling than it has been for the last 20 years. And sterling is going to have the widest carry, the largest carry of any major currencies. And when we look at the past, that can be important. And what we find is that the change in an exchange rate, sort of month to month or week to week, is a function of that level of that difference rather than the change. And it means that currencies can trend higher and lower if monetary policy conditions, central banks don't change interest rates. And I think that could be quite a dominant theme. In terms of the Bank of England, I don't think we're learning very much in terms of the data. We still think inflation is going to be sticky in the UK, and it means that the Bank of England will have to be cautious on cutting rates. The data have been a little bit mixed. We've had a little bit lower inflation. We've had some mixed employment numbers, labour market data. The PMIs this week were a little bit softer than expected. But we don't think that's enough to give the central bank confidence that inflation is coming down. So when we think about the end point, the landing zone of the Bank of England's easing cycle over the next sort of year or 18 months, it feels like that's going to be significantly higher than it will be for a lot of European currencies. For example, the Ritzbank looks like they're going to cut 50. Bank of Canada this week, 50. New Zealand recently, 50. The S&B continues to cut rates. Now there's even speculation that the ECB would cut 50. And I think that's positive. The other point I just want to make when I'm talking about sterling is this relationship between fiscal policy of the budget, between the willingness of people to want to invest in the UK and, importantly, reside in the UK, and whether the budget shifts that as well. So interaction of monetary policy, fiscal policy, but there's lots of other ways to think about the budget that could be important for the currency.
So taking this back to maybe the more immediate term, we have seen sterling versus the dollar retracing lower over the last couple of weeks. Now, I feel like, if we're looking for a main reason for that, it's really my side of the pond, which is probably doing a lot of that heavy lifting. But we'll come on to the dollar in a second. But I did want to get a sense from you about what you're thinking about sterling in general here, as we've seen the dollar bounce back in a lot of cases, including against sterling.
Yeah, I think you're exactly right. The sort of poster boy for FX markets tends to be sterling dollar. It's all about the dollar, and super interested to hear your latest thoughts on moving betting markets and probabilities around the US election and the dollar just generally. But I was seeing sterling underperform during October. But when I look at the relative performance, the dollar has been the best performing currency in October. And the next one, it's sterling. And actually, sterling has outperformed. And one of my key focuses at the moment is whether sterling euro, so sterling against the euro, can break higher, and whether we're in sort of price discovery post-Brexit. I know that we left the European Union, UK, some years ago, but we're still trying to sort out what's the fair value for the currency after leaving the European Union. And of course, we keep getting these what seems to be once in a lifetime events that seem to come every 2 years. So we had COVID, we had the energy crisis, and now we're back there. And I still think that the story for sterling is relatively simple. but not so much about the specific risks around the UK. It's just about relative growth, relative monetary policy. That's been a really good friend during 2024. And I think that's the way to frame the outlook for next year, as well as how you offset a current account deficit with that capital inflow. And that's why that balance between people wanting to invest and reside in the UK from the budget. So monetary policy, fiscal policy, all very much in focus. Not so much direct politics here in the UK, but it seems to be dominating the US and the dollar. I've seen the betting market seems to have shifted quite significantly in favour of Trump. Just wondering how you're thinking about that and the potential impact on the Fed, for example.
Yeah, so I mean, over the month of October, the dollar has seen a pretty meaningful appreciation, in a lot of cases bouncing back from its previous low point. So you can mark the low in the dollar index as the end of September, the final day of September. And I think two important things have happened over the last couple of weeks to really define that move. One of them is the election. I'll touch on that in a second. But the other comes from the economic data, right? Watching the evolution of the economic data, it seems like we are, it's almost the market's opinion and view on the status of the U.S. economy seems ever evolving. In the case of maybe disinflation, maybe slower growth expectations over the prior couple of months, we may be taking a few steps forward in that narrative. This month's data maybe represents a bit of a step back in terms of that narrative. And you have seen the economic surprise index here in the U.S. has actually risen to its highest level this year. And we're looking at the much stronger economic data over the most recent numbers. So you're thinking about things like the non-farm payroll number at the beginning of the month coming in stronger than expected, retail sales coming in stronger, and some of these initial jobless claims numbers, which many think are due to be influenced by the results of recent natural disasters here in the U.S., have actually moved lower as well. And so, market consensus has really been shifting around quite, in quite a large way around around the very specifics of near-term data. And so that data has improved, and that's helped support the dollar. So that's one driver. And it's really a hard one to really pin down because the market seems very willing and able to change its outlook for the Fed and what the Fed's easing cycle looks like very quickly. And so we've had a few months prior, we had some slowing data, some more confidence in the Fed easing. Now markets have pared that back. As that has been occurring, over the last few weeks, we have seen a meaningful improvement in Trump's implied odds of becoming the next president in betting markets. As we sit here today and record on Thursday, the 24th of October, Trump is at about 60% odds of becoming the next president in various betting markets, whether you look at sites like Polymarket, Predicted, and others. That's a very substantial move. And I think it's perhaps larger than what would otherwise be implied by the direction of the polls. I would say that two things have happened here. The first one is that there's been a momentum push. Momentum has been the big story of this race, and ever since Harris took over the top of the ticket in July, she has seen a big momentum boost in her favor in terms of polling. So she went from being, Democrats under Biden went from being at a small deficit to Trump to being at a modest lead. So what has happened in the last couple of weeks is her polling momentum has stalled. She's no longer gaining ground. If anything, she's steady or slightly losing ground. So that is one thing. The other is that we've had, a potential increase in the amount of money going into these betting markets that has been seemingly geared towards Trump. Now, whether that is, signs of individuals who are, taking advantage of these, using these services more, putting more money on, or whether or not that's a sign of greater confidence in Trump, is anyone's guess, really. But when you put these together, I think it's clear that Trump has become the consensus. And that, I think, has sort of increased this dollar move that we have seen. It's added a bit of fuel to that move, especially when you look at rate markets. One thing to flag on this as we look at how the dollar and rates have reacted in the last month is you haven't just seen higher yields in the U.S., you've also seen higher term premium, which is a reflection of the premium that the market requires to hold longer term debt over short term debt. And the reason this matters is because one of the ways that we think markets will account or have to price for a Trump victory if it happens is that significant new fiscal stimulus could lead to higher deficits and higher long-term borrowing needs, which could increase these types of premiums. So the fact that you're seeing higher rates in the US and you're seeing higher term premium, that gives you a hint that this dollar move higher is not just because of the data, but it's also because of Trump's odds moving. I would say personally that I think the moves in the betting odds in favor of Trump have gone further than I would have suspected based on just looking at polls. If anything, most, if not all, of the polls tell you that this is still going to be a very close race. If I had to handicap it today, I would say Trump at 60% odds, maybe a little overpriced here. But the reality is that this race still looks extremely close. 50-50 race at this point feels like a very reasonable outcome. So does that mean that markets may be a bit overpriced for Trump, maybe dollar a little bit overpriced for Trump? I would say that, but I wouldn't say with a lot of confidence that Harris is necessarily going to win. Although I think if you're looking at betting markets at 60-40 and the market consensus clearly shifting towards Trump, maybe having gone a bit far if you look at it relative to the polling averages, which haven't moved nearly as much.
Yeah, it's all very clear going into the major event of the year, and it's 50-50 chance. I was just wondering about what you expect in sort of market moves in terms of the two potential, or maybe there's a few different types of outcomes, sort of market moves. You alluded to how the dollar might have been supported by Trump, but you've also had that US data. But anything really changed there for you on the election as we run down the clock?
I think the core of the outlook is unchanged. And our view that Trump would be the stronger dollar, higher yield, higher term premium style outlook really feels like it's been validated by the moves in markets that we've seen over the last couple of weeks. Now, as you rightly said, Paul, some of this is data. There has been a meaningful repricing of Fed expectations around the data, and you have seen data surprising to the upside over the past month. So it's hard to disentangle those two drivers against each other. But we feel a bit more confident that the direction of travel, if we were to get a Trump victory, is in the direction the market's currently moving, which would be risk of a stronger dollar, both globally and against what I would consider a couple of currencies, especially in emerging markets where there could be specific geopolitical risks. Usually you're thinking about Mexican peso here, Poland, China, as regions where geopolitics, if we get a return to a Trump-style America first, you could see dollar strength in these, against these specific currencies. But broad dollar strength if we get a Trump victory, especially because we think Trump is more likely to win with united government if he wins, thanks to the dynamics of the Senate in this race. Because Trump has become more consensus here and the dollar has rallied off of its lows, I do think there's maybe greater scope for a move if we end up with a Harris presidency. And that's not to say that we think that Harris is necessarily a massive dollar negative, but the way we've been thinking about Harris for this whole race is that a Harris victory, the most important thing for markets is that Trump did not win. And so markets will be pricing out the Trump alternative. So if we think Trump is the stronger dollar outcome, then Harris almost by default becomes the weaker dollar outcome. And if we think the markets are increasingly either positioned or expecting Trump to win, which we think has become a clearer consensus over the last couple of weeks, then maybe the potential moves, if Harris does pull out, the victory could be potentially larger. And in that case, we're thinking about a weaker dollar. And again, it's not necessarily because we think the policies from Harris, if she were to win, say with united government, would be any less stimulatory. The risks around new deficit funding are still there in our outlook. But we do think that markets will be handicapping this election all around Trump. And if the market consensus now feels that stronger dollar and maybe higher rates on Trump is maybe more likely and have been pricing in that direction recently, then maybe that skews the potential balance of risk that if we get Harris, that's less likely in the minds of the market. And so therefore maybe as likely to create a meaningful response in FX markets.
It's interesting you were talking about the market impact from various outcomes, because I think a lot of people think even if they knew the outcome today, they're unsure about how it might play out, and also sort of timings, because here in the UK, when we have a change of government, it's pretty brutal that the next day you get the change. But in the US, it's takes longer for the transition to happen. And also appears to be uncertainty, doesn't there, about the actual exact timing when we might get the results. Just maybe very briefly, last question. How are you thinking about that timing, and what are the kinds of things that would impact that?
Yeah, so a lot of really good points, Paul. And before touching on the specifics of timing, when we'll know the results, I think you bring up a good point, which we should flag, which is that the lag between when the new government wins the election in November versus when the government can realistically change policy, it's at a minimum until January. The new government doesn't come in until January. So even if the market is accounting for significant changes in fiscal policy, at earliest we could get any real substantial changes, is in sort of the end of the first quarter, beginning of the second quarter of next year, assuming that, you have to get legislation has to be written. If you want to change the tax code, you got to spend a lot of time actually writing those new policies, getting those new policies through Congress, right? Working with different constituencies. There is a big gap between when the election happens and when the actual fiscal change can come through. We certainly see that with the UK and the budget where the election was a few months ago. Now we're talking about those implications. So that's an important thing to consider, especially thinking about the Federal Reserve, right? You mentioned the Federal Reserve at the top. The Fed is going to have a decision to make on the 7th of November, and we think the election result at the presidential level will be in hand by that time. The Fed's going to have a difficult task at hand, which is how do we account for potential changes in fiscal policy that might be 6 months away at a minimum, 2 days after the election? I think that's going to be a difficult task for them. It may be difficult for them to either justify or to sort of create essentially a reason not to go with whatever their pre-plan was going into the quiet period ahead of that meeting. In our case, we think that's a 25 basis point rate cut. So that's an important consideration about timing in terms of when the election happens and how soon we can get implementation of actual policies. In terms of timing the results, if you're watching the results hour by hour, if you're going to be up all night like I will be, trying to figure out this election in real time, we think the risk of delayed results at the presidential level is actually going to be lower in 2024 than it was in 2020. So the election was effectively called for Biden on the Saturday in 2020 after the Tuesday election. So it was a couple of days before the market had, I guess, formal confirmation that Biden had emerged victorious. We think it's more likely that we'll know the results on election day. And there's a change in the way that late arriving ballots by mail are going to be treated in some of the critical swing states. So not to get too deep into the weeds on this, but 4 years ago, a couple of the big Midwestern swing states that we really follow closely that we think will decide the election, they allowed for ballots. If you mail your ballot and you send it to the post office before the election, but it arrives after the election, 4 years ago, a lot of these critical swing states allowed those votes to count, even if they arrived in the ballot box after the official close of polling on the night of the election on Tuesday. 4 years later, in 2024, a lot of these important swing states are not going to be allowing those late arriving ballots to count anymore. So what that means is it will take a while to count all of the votes, of course. It's going to take a while to process votes. You have to go through and check the signatures, make sure that you are who you say you are. If you filled out your ballot correctly, there's a lot of stuff that has to happen to count the votes that we have. But a big difference in some of these critical swing states between now and 4 years ago is that every vote that will count will be in hand when the polls close. So we're not thinking about in some of these big swing states. Some states do allow those. They do allow the late arriving ballots to count. But in the big swing states that will decide the presidency, we think every vote that will be counted will be in hand when the polls close. So the question about delayed results will be about how long does it take to count? So we think it's more likely that the markets and the Federal Reserve as well will know the presidential results and can start pricing towards those potential scenarios, start pricing towards the winner sooner than they did 4 years ago. So with that, we've covered a lot of ground here, both in the UK and in the US. So Paul, thank you very much for joining. Really appreciate the conversation. And to our listeners, as always, thanks very much for listening. If you enjoyed this podcast, consider giving it a like and also subscribing to our channel so that you get our latest content the moment it's released. Thank you very much.